Hello, welcome to Tuesdays with Lloyd's special edition on Cyber Showcase. In the previous session, our experts has covered the cyber business interruption. Today, we're focusing on the topic of cyber physical damage. Leading discussions are Gillian Anderson, Global Head of Cyber and Technology at SCOR, Sébastien Héon, Deputy Chief Underwriting Officer at SCOR, and Kristen Pete, Corporate Risk Manager at CBIZ. Kristen, please take away from here.
Thank you, Enya, and welcome to Gillian and Sébastien. Everyone understands property damage in the traditional insurance coverage sense, but what happens when it's caused by a malicious cyber event? Where does the market stand on this evolving topic, and how is the threat landscape evolving in this area? I'm really happy to have Gillian and Sébastien here to help us navigate through this. So let's start with Sébastien. Can you give us an overview of the risk landscape in this area and how it's evolving and making this a growing risk for risk managers to think about?
Thank you, Kristen, and thank you for the introduction. Yes, cyber physical damage is definitely a growing risk for several reasons. The first one is that the exposure to this kind of risk is growing. It's growing because the number of connected objects is growing. In 2021, for example, the number of connected devices was estimated at between 45 and 50 billion devices connected. And by 2030, this figure is expected to jump to 125 billion connected devices. So it's a huge evolution. On top of that, these connected objects become closer to our daily lives. The frontier between cyber and real life is shrinking a lot. An obvious example is connected cars. Another one is the connected medical devices, and especially those implemented in the body, like pacemakers, insulin pumps, etc., who are more and more interconnected to external systems. And the impact of cyber attacks against those devices and connected objects are going to become more tangible. So we really expect that the cyber physical damage is going to grow. And it's true as well for larger exposures like Industry 4.0 and the interconnections of factories with robots in assembly lines, etc., and the supply chain being an integral part of an ecosystem. And we have seen, it has not been physical yet, but we have seen many attacks arising from the supply chain, and probably with these growing interconnections, the physical damage element is going to grow. We have seen a couple of real-life cases already and near misses. Probably the most famous is Stuxnet in 2011 to disrupt the nuclear facilities in Iran, so with physical impacts. Another one in 2014, end of 2014, yes, was a cyber attack against a steel factory in Germany, leading to a pot freeze in the factory, so physical damage again. A very interesting near miss was an attack, a cyber attack called Triton, targeting a refinery in Saudi Arabia, where the attackers were disconnecting the safety mechanisms silently from the control room. So the people in the control room in charge of monitoring the safety of the plant were not seeing any sign of explosion, rise in temperature, rise in pressure, etc. Fortunately, the virus didn't work, but it was already present in the network. So there are many signs of this exposure growing, and this is really one risk keeping me awake at night. If you're interested, there is one very interesting video. It's 1 minute. It's a proof of concept done by engineers at the US Department of Homeland Security, and they have filmed what they were able to do against a power generator in real life. It has been filmed by CNN, and it's available on YouTube. Just 1 minute, and you can see the machine explodes. So, I mean, this is for real.
Wow, great. Gillian, can you give us an overview of the current market coverage gaps here?
Yeah, thanks, Kristen. Yeah, I think following NotPetya in 2017, where there was thousands of companies impacted, and a lot of those losses arising from the cyber event actually were borne by the property market or the marine markets. Subsequent to that, there was then the Dear CEO letter from the PRA, which was looking to address affirmative and non-affirmative cyber. And they were looking for syndicates and insurance companies to be able to quantify how they were measuring this exposure, and certainly in the non-affirmative space, and how they were pricing for this exposure, or if this was being excluded, to what extent the coverage was provided. So then following on from that, the LMA panel actually drafted some new and mandatory language, which wasn't replacing 291415, but was certainly kind of an improvement of that language in the past. And so they introduced two new clauses, 5400, which was an absolute exclusion. So any physical damage, contingent business interruption arising from malicious or non-malicious. And then 5401, which excludes malicious and non-malicious, but does provide a right back for the non-malicious fire and explosion arising from non-malicious. So very much creating a gap in the market, certainly around the malicious exposure, and in some instances around the non-malicious, which, you know, at this point in time, as Sébastien just kind of alluded to, there's a lot, you know, there is a lot more activity in the market now, certainly around these operating technology systems. So this, these changes definitely kind of introduce more interest from clients in that space.
Great. Well, Sébastien, I'm getting ready to start working on my renewal applications for my cyber, and maybe you could help me and the other risk managers on here, as well as the brokers who have clients. What are you looking for when you're assessing these risk controls for the cyber property damage space? How can we demonstrate to you as a carrier what we might be doing, or what can we do better in order to be a better partner with you guys?
Thank you, Kristen. And this is a very interesting question. As you said in the intro, cyber physical damage is really different from traditional physical damage, because a cyber attack can impact simultaneously several locations, several companies even. So the risk management need to have a specific approach to this exposure, I think. So when we are looking at this exposure, and in your case, while preparing renewal, there are, in fact, 5 main topics that we want to address, and most are really common sense. I mean, it's just to ensure that there is a plan to mitigate this exposure and to take it into account. So the first one is the risk governance, and this specific risk governance for us to understand who is in charge of what. Because, you know, in larger companies, there is usually a CISO in charge of IT security, and there is a site production manager who is in charge of safety and production. And sometimes there can be some tensions between the two. So it's important for us to understand who has the ownership, the staff, the budget to address these cyber physical risks. So that's the first point. The second point is the access management and the asset management. So understanding who has access to what. And this is particularly important in 2 contexts. The first one is when there are employees working in shifts, because most often than not, they are sharing common credentials, they are sharing passes to enter critical facilities, and we need to understand how this is handled. It's normal from a work standpoint, but from a security standpoint, then we need to have a closer look at that. The other context is the remote maintenance, especially for those companies who are operating very big machines like a turbine or a cracker or this kind of things. The manufacturers often keep a connection to those machines to do maintenance, to do preventive maintenance, etc. And we need to really understand how it works, just to ensure that it's the manufacturer who accesses the machine and not someone else. The third point is the patching. And we know patching is difficult in OT, operational technology environment, because sometimes it needs to stop the production to apply the patches. So it's not easy to put in place. The next one is how the network is segmented. And especially when it comes to those big machines like the turbines, they are going to live for 30 to 50 years. But from an IT standpoint, a software standpoint, they are going to become obsolete very soon. So we understand that it's going to be challenging to maintain those the security level of those machines, but we need to understand how they are segmented from the rest of the IT to prevent any malicious attack on those. And the last one is tying back to the introduction is the recovery planning. Because as cyber PD is different from traditional PD, we want to have a look at the recovery plan for those cases where there are multiple sites impacted, for example. So these are really the main points that we want to look into.
Great, Sébastien. I appreciate all of those helpful hints that I will use when preparing my submission for you guys. Gillian, so you've talked us through all the gaps and all the bad news. But what can we buy? What can risk managers get on the marketplace to help protect our companies? And what can brokers offer their clients to make sure they're being protected?
Yeah, so there is good news there in the cyber world. That's nice. This isn't a new product. So effectively, for the last couple of years, there have been some markets that have been providing what we would call, I guess, a right back to some of the exclusionary language or standalone products. Quite often, these have been on a non-damage BI and physical damage basis, and a lot of the interest was certainly generated around the non-damage BI, and I think we all know why that is and why that's been. But as kind of these exclusionary languages have come into play and the gap has become more noticeable for clients, and as Sébastien's spoken about the kind of increasing risk threat landscape, there's definitely been a lot more interest from clients and insurers around how this gap, the malicious, certainly, element of coverage can be provided. So pleased to say the Lloyd's market does have a number of options available, again still on the blended basis, but also now actually just on a true physical damage basis only. That can be on a write back, so you can write back specified perils, so fire, explosion, machinery breakdown, or in some instances there is a truly standalone cyber physical damage malicious attack policy. So I would say in the Lloyd's market available now, you can get roughly 200 to 250 million of capacity. Obviously, when we talk about limits and capacity, that feels not as meaningful as what you can buy under a property policy. What I would say has been happening over the last couple of years is definitely a lot more cross-pollination and collaboration between property and cyber teams. So this is very much, you know, kind of the early stages of this product, as I see it. And I do believe that as we kind of further work with our property colleagues and understand more the risks, you know, and how the language works and how the kind of property policies work and interplay with the cyber, then yeah, I think we'll continue to see growth in this space.
Great. Quick question. How easy is it for an insurer to get an indication around this cost and coverage? I mean, are we having to fill out those kind of voluminous applications that we have for the other types of cyber coverage, or is this, you know, something that can be tacked on to that? Yeah,
the short answer is it can be quite easy to get a rough indication. So we're looking for your asset schedule, which you're already providing as part of the property renewal. So, you know, it's not a huge, it shouldn't be a huge ask, but obviously then what we're looking to do is, as Sébastien mentioned, focus very much on the operating technology and understanding kind of the constructs and segmentation and who has control of that. So you can very easily get a rough indication from the market purely on the asset schedule. We do have specific physical damage questionnaires, in some instances, you know, one-to-one client meetings or face-to-face client meetings. But these questions really aren't too different from what we're already asking as part of the non-damage BI. So hopefully no shocks for the clients in there.
Well, we have some questions from the audience, and I would encourage you guys to continue sending these in, but we'll go ahead and start with this first question. This is a good one. So given the cyber physical damage market relies on underwriting property and marine clauses. Do you think that these clauses are a fit for affirmative cyber policies, or do they need updating with the changing risk landscape?
I'll take that one, shall I? I mean, we're obviously writing back those clauses. There was a lot of work done defining cyber act, cyber incident. I think people are comfortable with what that means now, and I do think, writing back on that basis, it is very clear, in my view, to an insured what you are getting cover for. So I would say yes, they are. I suppose the element that brings confusion is there is coverage under cyber non-damage BI policies that you would look to apply to the write back that might not necessarily follow with the property form. So there is definitely work that needs to be done, and I think that's kind of where I touch on the collaboration between the property teams to understand the different exposures, what the potential risks are, and how you kind of dovetail those policies to make sure you're not kind of excluding coverage that you're meaning to provide, but also you're not kind of broadening coverage out more than where it already is.
So I know we talked a lot about, the cyber market, and there's only $250 million worth of maybe coverage that's available in London. And we've heard about some carriers pulling out of cyber. How has the physical damage market been impacted by the shrinkage of cyber capacity?
I think short of us all just not having any time to focus on it and spending all our time dealing with the kind of non-physical damage, I think it's taken a while to get off the ground because there hasn't necessarily been, prior to the clauses, there wasn't necessarily a kind of need for it as much. And now I think the clauses are driving that. They came into play in 2020. Obviously, from 2020, everyone wasn't applying these clauses. So, there's a lag time with them being brought, those clauses being applied. I think London, the US market, certainly moving in that direction. The international market is, fairly very spread out in terms of what they do. But I think, it is a big focus for a number of cyber markets, especially those markets who do write large property portfolios. It feels like an obvious cross-sell and an obvious solution to the client to provide a kind of more fully rounded product for them.
Well, that kind of leads into the next one. One of our listeners asked, well, you talk about you're working really closely with the property policies. So why can't we simply just add cyber risk as a peril within property? Can you talk us through maybe why that has been separated out?
Yeah, I mean, I wouldn't want to speak on behalf of the property market. I don't know about you, Sébastien, but I think they have their own worries at the moment that isn't cyber. Sure. I think there's a uniqueness to cyber, that kind of intrinsic connected risk that, I wouldn't want to try and just become a property underwriter. It is quite a niche area to try and understand the operating controls. So I think from their perspective, it's better placed and underwritten by the risk engineers like Sébastien, who really understand the complex operating technologies, and the cyber underwriters who understand kind of the threat landscape and the exposure. So yeah, I think I can't see it moving back into that property market. I think it's something that needs to be focused and treated as a standalone market.
Sure. This is an interesting one. Do you think that maybe the reinsurance market needs to be doing more on physical cyber? Or do you think it's important to just have this more bottom-up approach? Do you think there would be additional capacity? What are your thoughts on that?
Do you want to take this one, Sébastien, or?
Yes, maybe. No, I think it's a very good question. And as Gillian said, this cyber PD market is starting. So at the moment, I think it's interesting to look at how it evolves from the bottom up, and when it's going to grow, depending on the dynamic and where it's developing. The reinsurance can play a role to facilitate the market and make it more fluid and more dynamic. That's for sure. But maybe we need to have a look at how it starts first, and then help the development and support the development from a reinsurance standpoint.
Well, to finish up, I've got one last question, and I think this is a good one to end on. Is this coverage available worldwide, or is it just in specific areas? And what would be like the minimum TIV that you would consider as a new prospect? So
it is available worldwide. Obviously, there's territories where we're more cautious for obvious reasons, but I don't think that's really any different from kind of where the property market writes. Really, what we look to do is try and follow where the property appetite is, and then align that with the cyber appetite. It's a great question on the TIVs. I actually haven't considered it, but something that we can come back on, definitely.
great. Well, I wanted to thank you guys so much for your time today. I really enjoyed chatting with you. I learned a lot too. So I'm going to turn it back over to Enya. And thank you guys so much.
Thanks, Kristen.
Thank you, Gillian. Thank you, Sébastien. Thank you, Kristen, for the insights and wonderful discussions. So tomorrow, we're going to come back at the same time. Please join us tomorrow for Tom Bennett of CFC and Alan Cubis of eBay. We're going to discuss on risk management, technology, and future of cyber insurance. Exciting stuff coming up next day. So thank you again, all of you, and we'll see you tomorrow.
Sounds great.
Thank you. Thank you. Bye.